Every time you fill up your tank, there's an invisible hand thousands of miles away deciding the price. From the deserts of Saudi Arabia to the ports of the UAE, decisions made in the Middle East can shake the entire global economy. Picture this. A single drone attack in 2019 knocked out 5% of the world's oil supply in just hours. Oil prices jumped 18% overnight, the biggest single-day spike in decades. Airlines scrambled, shipping companies panicked, and stock markets around the world felt the tremor. How can one region hold such power over the world's oil prices? And what happens if that balance shifts? Welcome to the global chessboard, where barrels of oil are the pieces, and the Middle East holds the most powerful ones. Here's the reality. The Middle East doesn't just produce oil, they control oil. 5 of the world's top 10 oil producers are Middle Eastern countries. Together, they pump out roughly 26% of all oil consumed globally every single day. But here's the kicker. They hold 65% of the world's proven oil reserves. That's not just current power. That's decades of future leverage sitting underground. Saudi Arabia alone can produce 11 million barrels per day. That's enough to fuel the entire United States for 3 days. But here's what makes them truly powerful. They keep millions of barrels in spare capacity, ready to flood or starve the market at will. Think of Saudi Arabia as the central bank of oil. Just like the Federal Reserve can print money to stabilize markets, Saudi Arabia can pump extra oil to crash prices, or cut production to send them soaring. No other country on Earth has this kind of swing power. And it gets even more interesting when you realize that most of this oil is incredibly cheap to extract. While U.S. shale companies need oil at $65 a barrel to break even, Saudi oil is profitable at just $10 a barrel. That's economic warfare capability built right into the ground. Now, imagine if these powerhouse countries decided to work together. Well, they do. It's called OPEC. OPEC controls 40% of global oil supply and 80% of proven reserves. But in 2016, they got even more ambitious. They formed OPEC+, bringing Russia into the fold. Suddenly, this alliance controlled nearly half of all oil production worldwide. Here's how they move markets. Remember the 2020 COVID crash? When demand collapsed, OPEC+ made the largest production cut in history. 9.7 million barrels per day. That's like taking the entire production of Iraq and Iran offline simultaneously. Oil prices, which had briefly gone negative, stabilized and began climbing back up. But they can also use oil as a weapon. In March 2020, when Saudi Arabia and Russia couldn't agree on cuts, the Saudis opened the floodgates. They ramped up production, just as demand was cratering. Brent crude plunged 30% in a single day, the steepest drop since 1991. The message was clear: mess with us, and we'll crash the entire market. Fast forward to 2022. As the world recovered from COVID, OPEC+ kept supply tight while demand roared back. Oil hit $120 a barrel. The U.S. begged them to pump more. Their response? Another production cut of 2 million barrels per day, right before the midterm elections. This isn't just about economics. It's about geopolitical leverage. But there's another weapon in the Middle East's arsenal that's even more powerful than production quotas: geography. 20% of all oil traded globally passes through a narrow stretch of water between Iran and Oman called the Strait of Hormuz. At its narrowest point, it's just 21 miles wide, with shipping lanes only 2 miles wide in each direction. Here's the terrifying math. If Iran decided to close the Strait of Hormuz tomorrow, 21 million barrels per day would be cut off from global markets. That's more oil than the entire United States consumes. Prices could skyrocket to $200 a barrel or higher, enough to trigger a global recession overnight. Iran knows this. They've repeatedly threatened to close Hormuz whenever tensions escalate. Even the threat alone sends oil prices climbing. It's the ultimate geopolitical bargaining chip. And this isn't theoretical. History shows us exactly what Middle Eastern conflicts can do to oil prices. 1973. Arab oil embargo. Prices quadrupled in months, triggering global stagflation. 1979 Iranian Revolution. Oil doubled from $15 to $39 per barrel. 1990. Gulf War. Prices spiked 112% in just 2 months. Each time, the global economy felt the pain. Airlines cut flights, manufacturers raised prices, and consumers watched their cost of living soar. The 2019 attack on Saudi Aramco's facilities proved this dynamic is still alive. Drones took out 5.7 million barrels of daily production, about 5% of global supply. Markets panicked because they realized how vulnerable the entire system really is. But here's where the story gets really interesting. The Middle East isn't fighting just about high prices anymore. They're fighting for market share. The rise of U.S. shale oil changed everything. America went from importing oil to becoming the world's largest producer, pumping out over 13 million barrels per day. Suddenly, OPEC's monopoly was broken. So what did they do? They declared economic war. In 2014, Saudi Arabia made a calculated decision. Instead of cutting production to prop up prices, they flooded the market. Oil crashed from over $100 to just $26 a barrel. Their strategy was simple: bankrupt the higher-cost American shale producers and reclaim market dominance. It was brutal. Hundreds of U.S. oil companies went bankrupt. Tens of thousands of jobs were lost. Entire towns in North Dakota and Texas turned into ghost towns. But here's the twist. American shale survived. Companies cut costs, improved technology, and became more efficient. When prices recovered, U.S. production roared back to record levels. Today, it's a constant chess match. OPEC Plus cuts production to push prices up, making American shale profitable again. But if prices get too high, shale producers ramp up, adding supply and bringing prices back down. It's a delicate balancing act where every move is watched by traders around the world. The latest chapter? OPEC Plus just announced they're increasing production by 547,000 barrels per day starting in September 2025, even as prices hover around $70. They're testing the waters, seeing how much market share they can reclaim without crashing prices entirely. When the Middle East moves oil prices, the entire world economy shudders. Every $10 increase in oil prices adds roughly 0.3 percentage points to global inflation. That means higher gas prices, more expensive flights, pricier shipping costs, and ultimately, everything at the store costs more. But it goes deeper than that. Higher oil prices strengthen the dollar, since oil is priced in dollars globally. This makes imports more expensive for developing countries and can trigger currency crises. Look at what happened during the 2022 price spike. As oil hit $120, central banks worldwide faced an impossible choice: raise interest rates to fight inflation and risk recession, or keep rates low and let inflation run wild. Airlines saw their fuel costs, which represent 20 to 30% of operating expenses, skyrocket. Shipping companies passed the costs on to consumers. Farmers paid more for diesel to run their equipment and fertilizer for their crops. The ripple effect touched every corner of the global economy. And here's the cruel irony. Oil importing countries suffer, while oil exporters celebrate. Every price spike is a wealth transfer from the rest of the world to the Middle East. Higher prices mean more foreign currency flowing into Gulf sovereign wealth funds, which then get invested in Western companies and real estate. It's economic leverage on a massive scale. But here's the million-barrel question. How long can this last? The world is changing. Electric vehicles are gaining ground. Renewable energy is getting cheaper. Countries are desperately trying to reduce their dependence on Middle Eastern oil. Yet the numbers tell a different story. Global oil demand just hit a record high of over 100 million barrels per day. China and India, the world's fastest-growing economies, are still hungry for oil. The International Energy Agency predicts demand will keep growing until at least 2030. This puts the Middle East in a fascinating position. They know their time as the world's energy kingmaker might be limited, so they're adapting. Saudi Arabia is investing billions in renewable energy and trying to diversify its economy. The UAE is positioning itself as a clean energy hub, but they're also not going down without a fight. OPEC Plus continues to manage supply strategically, keeping prices high enough to fund their economic transformations, while low enough to discourage too much investment in alternatives. And here's something most people don't realize. As the world transitions to electric cars, oil demand for petrochemicals, plastics, fertilizers, synthetic materials will actually increase. The Middle East could remain relevant in different ways. So the next time you're at a gas station, remember this: you're not just buying fuel. You're participating in one of the most complex geopolitical games on the planet. Every price at the pump reflects decisions made in boardrooms in Riyadh, tensions in the Strait of Hormuz, production meetings in Vienna, and conflicts you see in the headlines. The Middle East doesn't just sell oil, they sell stability. Or instability, depending on their next move. They've mastered the art of turning black liquid into political influence, economic leverage, and global power. And as the world shifts toward renewables, one question remains. When oil is no longer king, who will claim the throne? Will it be the countries that control lithium for batteries? The nations that master hydrogen technology? Or will the Middle East find a way to reinvent their influence once again? One thing's for certain. The invisible hand that moves your gas prices isn't going anywhere anytime soon. Thanks for watching. If you found this video useful, don't forget to like, share, and subscribe to the Capital Compass, so you won't miss any future deep dives into the forces shaping our world. See you in the next video.